arbitrary, yeah. I mean, it does have to, it does work into the balance sheet in terms of the balance sheet balancing, you know. But yeah, it's basically arbitrary. It can easily, I've seen common stock par 0.001, you know, which is theoretically a lot of times, you know, many times less valuable, but it doesn't really matter anyway because, you know, you're talking about a public company where there is an actual value on current value on the publicly traded stock. That's whatever it is. You know, so for CVS, $25 or whatever it is today. You know, 35, whatever. Yeah. And so, statement of cash flows, you know, is basically going to start off. Now, just from a basic standpoint, like I said, we can't give an accounting class, but from a general standpoint, the income statement is going to give us just a feel for the profit and loss of a company. Just on a high level, profit and loss. What you brought in, what you paid out in expenses. You know, the balance sheet. You know, and that's over the course of a year. The balance sheet is going to give us a snapshot at a given point in time, usually the most recent period, the most recent quarter, or whatever, you know, of a company's asset and liability situation. So it's a snapshot, right? The CAD statement of cash flows is basically going to give an indication of how money flowed through the company throughout the year. So it's not just the P&L, but it's just going to give us a detailed look at exactly how everything played out. Because in the real world, companies are just doing things. You know, they have bills, they pay them, you know, they hold off on them if they can, these kinds of things. But you have to reconcile everything. And so statement of cash flow is important for that. Again, when we write stuff off, you know, it's got to come out of somewhere. And, you know, we have to determine what the cash position is going to be from year to year, from quarter to quarter. Statement of cash flows starts us off with net earnings, which is sort of where the income statement leaves us. You know, and so, you know, again, we would add back, you know, a potential restructuring charge. You know, we add back depreciation here. We add back amortization. We add back, you know, deferred income taxes or other non-cash items. You know, and again, here we're calculating the change in working capital. Accounts receivable in this period was reduced by $86 million, which is a use of cash. You know, because if accounts receivable are going down, it means we paid something utilizing cash, which is why it's a negative number. Inventories were reduced. Other cash assets, you're added back.
So in this
accounts
case,
payables, yeah.
In this case, the company was restructured prior to the acquisition.
Well,
because the forward estimates, I mean, there are 000 restructuring charges, whereas.
Right. Yeah, we're assuming. Yeah. So we don't count. Again, all of this stuff is the company as it is now. So we don't assume any of our added value or anything like that. Yeah. We just take it as this is what the company is.
Even for forward estimates?
Yeah, because, you know, or I'd say for the purposes of an LBO model, because you're gonna, you know, you're gonna build in, if you were doing a merger model, right, then you would actually build in, you know, you would actually build in potential synergies, right? But here we want to see sort of what's going to happen on the assumption that the company, yeah, does this, and then we can build sensitivity that says, well, what if our actual, you know, projections say the following? You know, so we can build in those synergies, but we just want to look at it now, you know, sort of as a blank, you know, simple template that builds out.
If the company continues
Yeah.
as they.
As they are, exactly,
Okay.
exactly. And so, again, CapEx or additions to property, plant, and equipment is the use of cash. So proceeds from properties that were sold and then leased back. So even though that's going to contribute more or cost more interest expense down the road, for the moment it's actually going to be a gain, just like a sale of property. So acquisitions that they made in 2000, total $263 million. So that's a use under investing activities. And again, assets that were sold, $18.8 million, is not a use of cash, but actually brings cash into the company. Okay, so we'll come back to the free cash flow calculation, but cash flows for financing activities. Now again, this is outside of operations. This is outside of investing in the things that people do to grow the company. This is where a lot of the hocus pocus comes in. Where you can see a company putting more cash on the books, but that's not necessarily from operations. They can just be selling stock, diluting shareholders. So, so as we break this section out, like I said, I apologize if people know this stuff already, but I just got to make sure we all move forward, same pace. But basically, reductions in long-term debt. So paying down debt is a use of cash. Proceeds from the exercise of stock options. So when people exercise options, they have to pay something, and so, they get the options, they get the stock, but in return they pay some price. And so based on that exercise, that they brought in about $98 million, just short. They paid out $104 million in dividends. They repurchased some stock out there in the market to bring in treasury shares, which cost them $163 million. So they actually took on an additional $138 million of short-term debt, which is why that's a positive number, so they did not retire that. And they didn't convert any preference stock. So if they had converted it, then that would reduce their preferred stock outstanding and brought in some cash on that. So, in this case, and like I said, as we can see in their financial statements, they increased cash by $107 million. Starting out the year, at the end of '99, they had $230 million, and so at the end of the year, they ended up with $337.3 million. So coming back to the cash flow, like I said, there's a lot of ways to calculate cash flow, but essentially, free cash flow from again, looking at operating activities, leaving out financing activities. If we take CapEx out of the equation, we end up with free cash flow of about $84 million. If we include acquisitions that were made, then we have negative free cash flow. And if we look at free cash flow, including all of the investment activities, we end up with about 139. So let's click over to our DCF here. And what you find is that we basically just took this directly from the income statement. And this is how it'll go in practice. I mean,